Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast, Investment Friday edition. It is currently Thursday, February 8th, just before 5 p.m. To put a timestamp on the market that we're talking about today, I'm your host, Hannah Chapman, and I'm here with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. What's up, Brad?
Hannah, not too much. The markets to a certain extent are up, which is nice. So yeah, that's always good to come on a day that things didn't fall apart or something didn't spin out of control, but things were okay. So I'm glad to be here.
Yeah. So today, before we started recording, we're talking about, hey, what's going on, what's happening in the markets. And you started talking a little bit about last year again and about the quote unquote magnificent 8 stocks that blew everything else out of the water last year, carried the indices, up quite a ways, almost all by themselves. And talking about like, what does that actually mean? And when we're comparing, because now, right, part of the thing that's happening now is we're comparing to last year. So now we have a year comparison of, all right, where are we from last year? What do we expect going forward? If you are evaluating your own portfolio and the performance and different things like that, you might be really wondering, hey, what's coming this year for these 8 stocks, for the market as a whole? Tell me about the conversations you've been having.
So I've just been a lot of clients and some advisors have been asking, they have portfolios they'll bring to me and they'll say, "Hey, will you analyze this? Take a look at it through your risk spectrum and see what comes out the other side. See what you think." And what I've noticed is a massive trend, and this happened with some very, very popular ETF model portfolios that large ETF providers put together for clients and advisors. Um, they did quite well in 2023. Okay. So their returns were very good. Unfortunately, when you start to analyze them, you find that they have a heavy, heavy, heavy reliance upon the Magnificent Eight top tech stocks. So all of the stocks that we were talking about last year, which are great companies. So I'm not saying they're not great companies. They're wonderful operating companies. They do a fantastic job with their products and services. However, the other component to that is their price. How much are you paying for those wonderful companies? And some of those companies have gotten to the point where it's almost ridiculous how expensive they are, which means if you buy them today, your future returns are going to be much less than you anticipate um, on those stocks, just simply because your price point, your entry point is much, much, much higher relative to their earnings. And so this is when I analyze these portfolios and I indicate, hey, there's a heavy, heavy reliance on these top 8 stocks. Your portfolio in 24 may not perform the way you're anticipating it did in 23. And in fact, if you roll it back even 1 year before then, one of the reasons 2023 was so good was because 2022 was disastrous for those stocks. All of them, they all fell pretty significantly in price. If you look at Tesla as one, it fell 75% in 2022, did quite well in 23, and now is off 25% year to date in 24. So again, you're starting to see this disastrous 22, really good 23, probably not going to be that good of a 24 for them, simply because they're all priced for perfection a little bit. And if that perfection doesn't come through, which probably it won't, it can harm their stock prices. So my my comments go to analyze your portfolios. Okay, not just what you own, whether it's a mutual fund, exchange traded fund, or individual stocks. Know how much of those stocks you own. Um, I looked at a portfolio and it was 100% in these had a very heavy reliance on those stocks. It had an exchange traded fund that was technology. It had one that was large cap growth. It had one that was communication services, and it had some in the mid cap growth area. Almost all of those on the underlying holdings rely significantly on those top 8 stocks. So while they did well last year, you got to know what you own on the on the inside. Otherwise, you might have a concentration in those stocks that you may not want to have going into 2024. Um, as we were talking before the podcast, this is very reminiscent of 1999, 2000, where the very few stocks, the top tech stocks, back then it was Intel, Microsoft, and a few others that are not around any longer. Some still are, but some are not. Did really, really well, but they also eventually fell back to the earth. This year, we have some macro trends that are changing, making it diametrically opposed to what happened in 23. 24 is very, very different macro setup. You have expected lower interest rates. Okay. That expectation of lower interest rates is going to do a couple things. One, it's going to accelerate earnings in certain areas that companies that are more levered, companies that are reliant on bank financing, on financing in general, are going to find it far easier to make their earnings projections when all of a sudden their interest costs go down that fast. And so you're starting to see small caps perk up. This is a great setup for small caps. They're extremely inexpensive relative to large cap. They've been extremely expensive for 10 years now, simply because of some of the Federal Reserve actions on the underside kept kept it where it was difficult. We don't think we're going to have a recession, so small caps do very terrible in a recession, but we think we're probably going to avoid that. We might bounce along zero or reaccelerate towards the end of the year. Um, so that's going to be good for their revenue streams. Um, Lower interest costs are going to lower their expenses, and you're going to start to see their earnings pop much faster than large cap and particularly the top 8. Um, but the setup is very, very good for small cap and for certain parts of um, value sectors. So
And so I kind of want to go back to what you said about like the overheating kind of that you're seeing in those top 8 stocks, and it being reminiscent of the tech bubble that burst in 2000, um and really like shook people pretty heavily. The I would say the generation that was retiring at that point in time, like it was a really significant event for a lot of people's portfolios, because again, those top stocks at that time, people were like, they're never going to go down. Right. That was the feeling, is like they're such good companies. This is the way the world is going. There's no way these stocks are going to falter. And then, like you said, some Intel's still around, Microsoft's still around, obviously. Um, but there are stocks that just evaporated, right? Companies that totally went under and are gone now. Um, Not saying that that's the case for any of these stocks that we've been talking about lately, but tell me more about what you see. Like, what's the corollary that you see so people can start to um, kind of put this risk into context, right? So if you are all the way in these large cap tech sector without any true diversification in your portfolio, like what what does that mean to you from a risk standpoint? And how is it echoing what we saw?
Yeah, so it's very very reminiscent of those days. In fact, when I was sitting there thinking about and I've done this throughout the past year as I think about the 1999 2000 time frame. At that time I had clients coming to me and they had five mutual funds, five different mutual funds. And we would analyze, because at the time it was very, very difficult to analyze your actual holdings, but we were able to do it. So we analyzed their actual holdings, and most of it was in tech. Even some of the value, like purportedly value funds they owned, would style drift significantly into tech so that they didn't underperform as much and lose assets under management. So they would style drift significantly, and people were usually pretty surprised by that fact. Now, usually they're totally okay with it until 2001, 2002 came around, and you had the tech wreck. And in that tech wreck, everybody started to realize that diversification was very, very important. I'll give you an example. The NASDAQ 100 reached a peak. We went through the tech wreck. It was down 75% and got back to, and it took about 13 to 15 years, depending, to get back to break even on that index. So it can be a really important thing. Now, today, you fast forward to today, everybody has a bunch of, they have some mutual funds and or individual stocks, but mostly they have ETFs, which are indexed. And these indexed mutual fund, or these index ETFs, are usually some kind of large cap index, cap weighted, okay, capitalization weighted, which means they have a heavy overweight in these top 8 stocks. Similarly, with their technology exposure, their communication services exposure is much higher than it otherwise normally is. Um, and they have all of these different ETFs that, if you analyze the underside, they own the exact same things. Even though it sounds like they're diversified, they own the Russell 1000 Growth ETF. They own the S&P 500 ETF. They own the Russell 1000. All of these are capitalization weighted indices that are overweighting right now these top 8 technology stocks. Okay. And I'm calling them technology, and that's incorrect. They're actually technology or technology adjacent, meaning Tesla is a consumer discretionary, but it's really a technology company as well. So they're either technology or technology adjacent type um, companies. And so this reminds me so vividly of what happened in the early 2000s, that things probably won't, I don't know if they'll go down. Let's just say that. I do think that they could pause for a very, very long time as their earnings begin to catch up with the price that they're valued at. And so for a lot of people that have these heavy concentrations, they may want to look, because they may underperform for the next few years as interest rates continue to come down.
And that's one thing we talked about last year as well when we talked about price to earnings ratios. And so we could, you know, um, do a little bit of a refresh on that, where, what are the price to earnings ratios of, some of maybe Apple or Amazon or Meta right now? Do you have those handy?
Yeah, so that whole group ranges from 25 for Alphabet. So Google is at a reasonable 25 is not terrible. Um, all the way up to 92 for
Mhm.
Nvidia. Nvidia is definitely the outlier there, but I would even say, PE from Tesla is even at 44 is probably, given what their future in terms of revenue streams for the next year or two, anyways, may not they that may be a little bit too expensive relative to what they're actually going to be able to do. great company, but I just think we're in this place where people are pausing. It looks like the demand for um, electric cars or BEV, battery electric vehicles, may be waning a bit, may not be accelerating nearly as much as people anticipated. In fact, you had Hertz and a couple of other rental car companies liquidate their Tesla inventory because no one was renting them and they were so high maintenance. Because unlike a internal combustion engine, when you store, when no one's renting a car that's electric, you have to continually charge it. So it's continually costing you money. Whereas an ICE engine, or internal combustion engine, you put gas in it, it can sit there for a long time until someone drives it. And then you can make money off the car. Well, battery electric vehicles are more high maintenance in that way. Similarly, they have very, very high repair costs when something does go wrong. Um, they're usually really good cars, so but that's always a cost. So you have rental car companies deciding not to renew their contracts and liquidate their inventory. Um, so it's a great company. I think that they're going to do great over the long term, but for the next couple of years, maybe a little bit more expensive right now than you'd want to have it. So they're pretty expensive relative to the overall markets. If you're looking at the, let's say, S&P 500 equal weight, that compares to about a 16 to 17
Mhm.
times earnings. So 16 to 17 earnings, very reasonable, very reasonable. Okay. But again, if you're overweighted in those higher companies, you're buying these things at an average of about 43 to 44 PE, which is stretched.
Right.
It's
And then
stretched for companies that are huge.
and then for anyone who needs just a refresh on what that actually means, what is a price to earnings ratio? What is that
Great
actually telling
question.
you?
Yeah, so it's you're paying a dollar for every, or excuse me, you're paying a certain price for every dollar in earnings. So if they produce a profit of a dollar, how much are you willing to pay for that dollar in earnings? So if someone's at 40, let's say they're at 45, you're paying $45 per every dollar in earnings. Okay. So if you think of it, you want to pay the lower amount of dollars for a dollar earnings. Okay. Normally. Now there's a couple of calculations and things you have to think about is how fast are those earnings growing, right? If you're doubling your earnings, well, you're probably paying 22 as opposed to 44, right? Because now the earnings will grow twice as much. So then that ratio looks better. But generally the rule is you want to get the biggest bang for your buck. And so generally lower PE um, makes more sense from a value perspective, getting more for your dollar that you're spending. Um, that has kind of been flipped on its head, and it does every single time we go through a mania or a bubble or a massive run up in one particular area. People start to redefine what PE means and why and how you would use it to purchase investments.
Mhm.
Some people go, well, I only buy the highest PE stocks because they grow the most. And that could be true, but you have to be careful because that's a very dangerous way of doing it. Whereas certain other companies, like David Einhorn, very, very famous value investor, what he has done, because again, value has been a terrible place for many, many, many years, almost a decade now. And what they do is they try not to rely on price appreciation in their investments any longer. What they do is calculate between dividend growth, and buyback percentage. How
Mhm.
much on a per share basis, what's that buyback yield? How much money are they returning to shareholders from dividends and from buybacks? And then capital appreciation takes care of itself over a longer period of time. And so he's done a great job. He's always been one of the top value investors, but that's the way he has determined for himself is eventually capital appreciation will come, but as long as I'm getting a high enough cash back to my investment, I'm good to go for the long term.
So that's yeah, that's an interesting way to think about price to earnings ratio. And and I've heard kind of the same too, right? Like I've seen investments that are at like 200, 250 PE for, companies that have really high growth potential. And the the one thing that I have experienced with clients over time is that you have to have an idea of when you want to get out of that investment. If it's got a very, very high PE and you're like, you know what, if I double my investment, if I get 100% return, I'm good and I'm out. Great. That's a good way to give yourself like, okay, this is what I want. And when I get it, I'm happy. If it goes up another 100%, I already doubled. I'm fine. It's when we expect, and I think this is what you were getting at earlier too, when we expect that, 50%, 100%, 200% return over and over again. And we stay in it expecting that over and over again. That's where it gets to be dangerous from an investment perspective that, hey, you might not be able to hit your goals if you are fully invested in only very high risk
Yeah,
investment.
I mean, I'm not full, or I'm definitely someone who wants people to take risk. Um, and people, clients ask me all the time about different individual stocks, what I think, and all those types of things, and I give them the opinion. Now, one of the things I always tell them is if they hit a home run, okay, let's say they double their investment, right? They get 100% return, they double it within a year. Take your investment out.
Yeah.
Let the profits run for as long as you want, but get your investment out and let's invest in something else. That way, you know you're playing with the market's money and not yours. Um, and that allows them to continue to continue to rebound or do whatever it is. Um, it's one of the things that I see people who make an investment, nail it perfectly. They can also give it away a lot by continuing to trade or buy these stocks at much higher prices.
Mm.
Um, had a client bought a company, basically it went up 4 times within about 18 months. So he crushed it. He literally made his portfolio mushroom. It just expanded quite dramatically. But he fell in love with that position. And so what happened is he started buying more as it went up. And he started to turn his 4 times investment gain into a he brought it way down because of
Mm.
the subsequent trading, because they fell in love with the company and the stock and not necessarily with what the price was telling him at the time on what the returns were going to be on a go forward basis. Um, so it still made him a ton of money, and I'm sure he's still very happy with it. But it's one of the things that I've seen is you have to if you get a company that goes up dramatically, you have to understand that you're running into the probability that the future returns will be lower than the ones you just experienced. Um, One of the things is with the top 8 stocks that I also want to talk about is um, if a company is worth $1.5 trillion, okay, to go up 10%, they have to add market value of $150 billion. So to just now that easily they can easily do that, okay, but to justify that on a fundamental basis from a revenue and earnings perspective, you have to increase those earnings a lot to justify. So essentially, they're adding a mega cap company just to get to a 10% return.
Yeah.
So it's like they're spawning this new mega cap company, $150 billion in market cap, all in 1 year. Well, all I can say is we're running into the law of large numbers, where because of your past success, your future success will be less just by virtue of the fact that you are so large. And at a certain point, that tends to not work out over time. People would always talk to me about, back when I began managing portfolios, we'd talk about ExxonMobil. And ExxonMobil, well, everybody has to have oil. Everybody has to have gasoline. ExxonMobil can't go down. They paid dividends for 100 years consecutively. They can't go down. Well, they did though, and so I would have people just challenge the estimate of what they think these things can do. Um, I saw an article the other day that said, and this is where I'm really wanting to hit, is in 1990, you had to have 7 people to do the job that 2 people in 2020 can do.
Hmm.
So that's called productivity growth. And that came primarily because the innovation of the internet, right? 1990, the internet was commercialized and it was really starting to grow. By 2020, we're talking about AI. The companies that will make money from AI are not the Microsofts, it's not the Nvidias or the semiconductor companies. That's not who's going to make the most money from it. It's the companies that use AI to increase the productivity of their employees. They can either trim their workforce or they can do a better job at taking care of their clients via AI. That is who's going to make money using the technology to streamline their cost structure. That's where the most profits are going to come, which is why I think for the United States, we have a really good 5 to 6, 7 years of growth here, where AI is going to really trim down the labor cost and really perk up some of the earnings of some of these companies, particularly small caps. And the reason why is because large companies, for the most part, already have chat bots. They're already doing those types of things. But for a 2 to 3 man company, they couldn't have afforded that right now. In fact, a website was probably stretching their financial balance sheets. Whereas with AI, it's getting to be so inexpensive that you can use it as a tool to reach out to your client base. And so these small companies across the country that are kind of a cottage industry of doing various services and products, they'll be able to use AI to do a lot of things. And so that is going to be where I believe that you have the most impact, the most bang for your buck for the next 5 to 7 years, where you start to see those earnings really start to perk up from starting this year, lower interest rates, but also from that innovation wave with AI that's coming through that will really, really, on a relative basis to large caps, they will really drive their earnings much higher, much faster than the large companies that, to be honest, make so much money. It's very, very difficult for them to continue to increase it.
And so uh, I think that's a really good spot to like recap and wrap up here because it points back to again what we were talking about in that price to earnings um episode last year, that if you can get in, right, and it's all it feels like to me. So the way my brain works is that I see big patterns. I see the synthesize, how does this information synthesize with what we've talked about before. We've talked about when interest rates come down, right? That's really good for small caps, small mid, companies that rely on financing. When we kind of have a soft landing, we don't necessarily go through a recession again, supportive of small caps. The price to earnings ratio, right? Like again, supportive of these companies that have not had such um, outsized returns over the last year. So it's all coming back into this like diversification. Look into your portfolio, do some kind of X-ray, see what you're actually invested in, and see how diversified you actually are. And if you are, all in these big tech communication companies, and that's like 80-90% of your portfolio, that might not be where your returns are going to lie going over the next year, 5 years, 6 years, etc. So,
Yeah,
good stuff.
I think that's perfect. Great recap. Great summary.
All right, got it. Well, thank you, as always, for being here and talking with us this week. And if anyone has any questions, we'd love to get your questions and to answer them on the air. You can email me at hannah@expansiveceo.com. That's HANNAH at expansiveceo.com. And Brad, how can people get a hold of you?
You can get a hold of me at www.juncturewealth.com. That is our website. There's some links. Contact us. You can email me there, or you can email me directly at bhaines, BHAINES at juncturewealth.com.
Awesome. Thanks for being here, Brad. We'll talk to you next week.
Thank you very much.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.